An update has been issued to cash ISA holders, pension savers and those with savings accounts following the change of tax year this week. The tax year changes every year on April 6th. It means that for various savings, tax, pensions and other rules and limits, the new financial year brings a new set of allowances to be followed, to avoid the shock of a nasty tax bill later down the line. Financial experts at investment platform Hargreaves Lansdown have issued guidance to its customers about what it all means for people with cash ISAs, stocks and shares ISAs, private pension funds, savings and other financial products for this tax year, running from April 6, 2025 to April 5, 2026. Despite widespread speculation that cash ISA limits were about to be altered by Chancellor Rachel Reeves, they remain set at £20,000 for the year. But there are a raft of rules and limits to be aware of for the new tax year. In a message to customers seen by the Express, Hargreaves Lansdown said, "The new tax year is here. To help you make the most of your money this year, here's a straightforward overview of tax allowances for 2025-26. ISA allowance remains at £20,000 across all ISAs, including a £4,000 allowance for lifetime ISAs. You can now open more than one ISA of the same type in a tax year. Pension annual allowance remains at £60,000 but can be as little as £10,000 for high earners or if you've accessed a pension. Junior ISA allowance, invest up to £9,000 in a child's future. Personal allowance, earn up to £12,570 before paying tax. Dividend allowance remains at £500 this tax year. Any income received from dividends above the allowance is subject to tax at your marginal rate. Capital gains tax allowance remains at £3,000. The profit or gain made when you sell or transfer an asset that's increased in value since you acquired it, which is above this allowance, is subject to tax. Personal savings allowance. The amount of interest you can earn on your savings before you must pay tax on it is £1,000 for basic rate taxpayers and £500 for higher rate taxpayers. It added, "This is information only and not advice. If you're not sure what's right for you, please seek advice. Tax rules can change, and benefits depend on personal circumstances." The start of a new tax year brings with it a refreshed individual savings account, ISA, allowance for savers to take advantage of until the following April. Despite rumours of potential changes to regulations that could see the annual savings cap on cash ISAs reduced, the adult ISA allowance for the 2025-26 tax year remains unaltered. Chancellor Rachel Reeves was reportedly cutting the tax-free allowance on cash ISAs from £20,000 to £4,000 in a bid to encourage people to put money in investments instead. However, the government has yet to announce any modifications to ISA allowances, with limits staying consistent for this year. This means adult savers can deposit up to £20,000 into a cash ISA, where savings will be exempt from income tax and capital gains tax. The junior ISA allowance also remains steady for 2025-26 at £9,000. While savers have until April 5, 2026, to place savings into a cash ISA, financial experts are advising savers to open an ISA and invest the yearly £20,000 allowance now rather than waiting until the end of the fiscal year. By investing in an ISA at the start of the financial year, your savings have the opportunity to grow tax-free for a significantly longer period, aiding you in maximizing returns. Alice N., personal finance analyst at Best Invests by Evelyn Partners, highlighted the importance of utilizing ISAs for tax efficiency, especially given the current UK tax climate. She said, "Making use of ISAs to shelter savings and investment from taxation is vital now that the UK tax burden is estimated to be at the highest level since the Second World War. The thresholds for paying the basic, higher, and additional rates of tax remain frozen until at least 2028, dragging millions more taxpayers into higher rates of taxation as their income increases. While many may feel a sense of relief now that tax year end is over, saving into an ISA does not need to be left until the last minute. With the annual dividend allowance standing at just £500, the capital gains tax exemption remaining at £3,000 and savings rates still on the higher side, taking advantage of the tax efficiency that comes with saving into an ISA remains important. Those who want to get ahead this tax year can open or top up their ISAs now. Not only does investing earlier in the tax year remove some of the pressure to make a hasty decision, it also ensures your hard-earned cash gets put to work for longer. After all, as the saying goes, the early bird catches the worm, and in the case of an ISA there is a whole year of potential tax-free returns to be had. Research conducted by Evelyn Partners, the parent company of Bestinvest, found that investing an annual ISA allowance of £20,000 at the start of each tax year can lead to a larger investment pot compared to waiting until the end of the tax year. Alice suggests an alternative to exhausting your entire cash ISA limit immediately is to make regular deposits to gradually increase your savings. She said, "Drip feeding your money into an ISA regularly, such as monthly, removes the emotion from investing. It is all too easy to have your investment decisions clouded by current market turmoil, events that will merely be a blip for those investing for the long term. Regular investing is a great discipline that keeps you going through the ups and downs and helps reduce market timing risk, as you'll end up with pound cost averaging, where fewer units of investments are bought at times when the market is up and more when it is down." Please share your thoughts and comments. How did you like my video, and please subscribe my channel for financial news.